and welcome to episode 16 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event driven activity over the past week. My name is Asif Suria, and I'm coming to you from the San Francisco Bay Area.
And my name is Tamanna Suria, and I currently attend the University of California, Los Angeles.
This week, we will briefly discuss a potential deal for Guess, further banking consolidation on the West Coast with another acquisition by Columbia Banking System, the spinoff of a robotics company, an insider purchase at an expeditions cruise company, and a whole lot more.
Before we begin, it's important to state that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.
Let's kick off the M&A portion of this podcast with a potential deal, or as we like to call them, deals in the works. Guess what? Guess was up 17% last Thursday on a potential rival bid by Authentic Brands Group, which could be higher than the $13 per share offer from WHP Global. Once again, there isn't a definitive merger agreement between Guess and WHP Global, so even for a potential deal, you have a potential bidding war going on at this point. It reminds me a lot of US Steel and the multiple parties that were interested in them. The stock had dropped as low as $8.57 2 weeks ago on tariff concerns. We discussed the potential WHP Global deal in episode 11, where we mentioned that WHP Global owns a motley crew collection of 14 brands, including Toys R Us, Anne Klein, Isaac Mizrahi, Express, and Joseph Abboud, that generate over $7 billion in annual sales. The stock jumped from $9.70 to $12.62 when that news came out. So it's down quite a bit from when that news originally came out and oscillates up and down depending on what is happening with tariffs from day to day.
The most interesting part of the original deal from WHP Global is that two of the co-founders of Guess are willing to roll over their shares instead of taking the $13 per share buyout. The CEO, Carlos Alberini, is also rolling over his shares. This new Authentic Brands potential offer is certainly interesting, especially considering that Authentic Brands has over 50 brands and $32 billion in annual revenue, which makes it nearly 5 times the size of WHP Global. They own brands such as Nautica, Champion, Reebok, Eddie Bauer, and many, many more. Many of these brands were acquired from different companies. Hanes Brands sold Champion to Authentic Brands in September 2024, and Authentic Brands bought Reebok for $2.5 billion from Adidas in March 2022.
I had no idea that Reebok was owned by Adidas and that they managed to get $2.5 billion for the brand, which hasn't really been on anybody's mind for, I think, at least a couple of decades at this point.
Yeah, Authentic Brands seems to be willing to pay up for things, so I wonder if they will be able to snatch up Guess ahead of WHP Global.
It depends. If you remember, we talked about how WHP Global had partnered with Guess on an acquisition, and so they have a relationship there. And the two co-founders, along with the CEO, have a little over 50% of Guess shares. So I think unless Authentic Brands puts up a higher offer that is very attractive, they might continue to decide to go with WHP Global. Moving on to current deal updates, it almost feels like each week there's a new update regarding the Acelyrin and Alumis deal, which as of last week was trading at a negative spread due to rumors of a higher bid. Well, those rumors turned out to be true, as earlier last week, Alumis and Acelyrin announced an amendment to their merger agreement, where Acelyrin stockholders will now receive 0.4814 shares of Alumis common stock for each share of Acelyrin common stock owned, representing a value of $2.41 per share.
Right, so prior to the announcement, shareholders were set to receive 0.4274 shares of Alumis stock. The spread on the deal was positive for a few days following the new announcement, but has since dropped down to a negative 5%. I wonder if shareholders are trying to squeeze out a little bit more, since the mysterious bid from the mysterious company D we mentioned a few episodes ago was still a higher offer.
Yeah, I'm surprised to see this. It went negative. We had the new deal announced. It went positive. Now it's negative again. So, yeah, you're right. Clearly, shareholders are thinking that maybe another offer, higher offer is coming. Doesn't always work out like that. I've seen multiple deals where it goes negative and it ends up closing at the original offer price, if you will. Another quick update regarding an existing deal. Discover Financial and Capital One finally got approval from the OCC and the Fed that they needed to proceed with the merger, which means now all the regulatory approvals are in place and the deal is expected to close by May 18th, 2025.
We'll wrap up our M&A section for this week with a look at newly announced deals, including the first billion-dollar deal of this month, which was the announced acquisition of Pacific Premier Bancorp by Columbia Banking System in a $2 billion all-stock deal.
Yeah, Columbia banking system has been on my radar since the regional banking mini crisis in 2024. I've followed Oregon based Umpqua Bank, which Columbia merged into last year, since the Great Recession more than 15 years ago. And I'd also once interviewed the prior CEO of that company. I felt that that merger of Umpqua and Columbia established a strong bank in the Pacific Northwest. The stock had dropped into the high teens on concerns about efficiency after the merger, and the dividend yield at one point was over 7%. The Pacific Premier Bancorp acquisition announcement once again caused Columbia's stock to dip to the $22 to $23 range, and I like the fact that they acquired Pacific Premier at just below tangible book value.
We talked about establishing a strong bank in the Pacific Northwest, but with this new acquisition of Pacific Premier, that gives Columbia exposure to Southern California as well. Considering Pacific Premier has $18 billion in assets and Columbia has over $50 billion in assets, the combined company will have assets of around $70 billion. The combined company will also rename itself Columbia Bank and they will drop their Umpqua brand. The deal is expected to close in the second half of 2025. But as we have seen with banking and insurance company deals, they usually take a lot longer to close than deals in other sectors because they require approval by multiple regulators.
Yeah, so Pacific Premier also sports a dividend yield of over 6.5%. And I'll be watching the spread on this deal closely to see if I could potentially start a position in Colombia at a discount through Pacific Premier. So, not necessarily just the arbitrage. I do want to at some point open a position in Colombia, and this might give me an opportunity to do so at a small discount, depending on where the spread might be. Let's move on now to spin-offs. A new spin-off was announced recently, but it'll only happen in the second quarter of 2026. The reason it caught our attention is because it's a spin-off of a robotics division. If the future is AI powered robots or a realization of James Cameron's vision in the Terminator movies, then this spin-off might be worth keeping an eye out for.
Well, back to reality for a moment. ABB Group, the global electrical engineering giant that is dual listed in both Sweden and Switzerland and has over 110,000 employees, is spinning off its robotics division into ABB Robotics. This is not a science project spin-off with limited or no revenue. ABB's robotics division is the second largest robotics manufacturer in the world, with $2.3 billion in revenue in 2024, representing 7% of ABB Group's revenue.
Yeah, imagine that 2.3 billion is just 7% of ABB Group. And so you can see how large that company is that most people haven't heard of. The robotics division has about 7,000 employees and operating EBITDA margin of 12.1%. Some of its customers include Tesla, SpaceX, and BMW. Although I'm not certain if they're using just ABB products or ABB robotics products. So that's something we'll have to look into as we approach the spin-off date. If Elon Musk ratchets up the hype cycle around Tesla and robotics, this ABB robotics business might benefit from the higher peer multiple comparison. Who knows, if he really ramps up the hype cycle to generate free money through secondary offerings of Tesla, he might even be able to buy this ABB spinoff.
Maybe. Moving on to stock buybacks, Google just announced a $70 billion buyback last week. And while this seems like quite a large buyback, considering Google's size, this buyback announcement represents just 3.6% of Google's market cap.
Yeah, after that announcement, I was looking at their buyback announcements history. As you know, we track a history of all buyback announcements, and then we check to see what kind of actual buybacks happen by tracking a reduction in the shares outstanding. So I looked at the buyback announcement history, and they reported $70 billion buybacks for 4 years in a row. So the five years before today, they had announced a $50 billion buyback. And then 4 years in a row, they announced $70 billion buybacks each year. They have also retired more than 8% of shares outstanding over the last 3 years. So clearly, the buybacks are not just to offset stock based compensation, but they are reducing the total shares outstanding as well.
Google reported results this week that pleasantly surprised Wall Street. Both search and YouTube ads revenue grew about 10% year over year, but the nice surprise was the 28% increase in Google Cloud and 19% increase in its other revenue from subscriptions, platforms, and devices. Google Network and other bets revenue were down about 2% and 9%. Overall revenue, though, was up 12%.
I think the Waymo service that they have, the robotic taxis, probably falls in that other bets revenue. And I was surprised to see that was actually down year over year. Announced GAAP earnings were bolstered by a big gain related to their SpaceX investment. So they must have had a mark to market gain because the value of the SpaceX investment went up. It was also interesting to see during the DOJ's antitrust trial against Google, they asked if OpenAI would be interested in buying Google's Chrome browser. And as you would expect, they said yes. I'm sure OpenAI would be thrilled to pick up Chrome, which would expand their customer base by almost 10x. Getting back to Google's core search business, we're starting to see an increase in traffic from both ChatGPT and Perplexity on Inside Arbitrage. I think it almost represents 5 to 10% of our traffic at this point. While Google's Gemini is making great progress, I think it would be premature to dismiss the risk to Google's moat from LLMs. I use all three of them, ChatGPT, Perplexity, and Gemini, but my default option for research is Perplexity.
Yeah, similar thing here. I really like Perplexity for finding sources and research that I could go on and then dive deeper into myself. But for explanations of general concepts, ChatGPT and Gemini do an okay job. I've actually started using Claude recently from Anthropic, and that does an even better job in my opinion, a little bit more accurate when it comes to explanations.
And you're right. And so the back end model that I use in Perplexity is also Claude, Anthropic's model, which actually seems to be quite accurate. But as they always say, trust but verify. We always have to double check the numbers.
Absolutely. Something to be wary of when using any sort of auto generated LLM or AI model. Moving back to buybacks themselves, generally speaking, this was a pretty heavy buyback week. So we're going to rapid fire cover some of the next few buybacks. Equifax, the credit bureau and reports company, announced a $3 billion buyback representing 9.65% of the company's market cap. The company's been doing quite well financially, and the stock is up about 14% in the last year, so not a major run up, meaning a buyback does make sense. On the other hand, Medpace Holdings stock is down about 24% in the last year. Medpace is a CRO, which stands for a clinical research organization. Essentially, the company provides drug and medical device development services and tools for various biopharma and biotech companies.
Yeah, Medpace has been on my watch list for some time now. I came across a company after an insider purchase by, I think its CEO or a director. And then the stock just went straight up before I got a chance to buy. So it's interesting to see it come back down again, and I'll be taking another look at the company. Medpace has actually been growing revenue and net income quite well over the last few quarters and years, and free cash flow remains strong. The buyback is a $1 billion increase to a previously announced $500 million buyback from February of this year. And the new $1 billion share repurchase announcement represents 11.17% of Medpace shares outstanding. Another similarly large buyback from the healthcare industry came from Pasaira Biosciences, which primarily focuses on developing non opioid pain management solutions. This reminds me a little bit of Vertex Pharmaceuticals, whose non opioid pain management drug was recently approved by the FDA.
Pasira's financials are a bit of a mixed bag, which is why it was interesting to see that the company is deciding to buy back 26.3% of shares outstanding, nearly one fourth of the company. We also saw a $1.5 billion buyback announcement from United Rentals, the equipment rental company founded by the billionaire Brad Jacobs of QXO and XVO fame, someone we tend to weave into almost every other episode at this point.
I was going to say that. I think you put it in there just so that you could reference Brad Jacobs. Moving on to insiders. This week, we were quite intrigued to see an insider purchase at an especially interesting company, Lindblad Expedition Holdings. I remember this company from, I think, 4 or 5 years ago when an insider had purchased shares, and I was surprised to see what this company does. It offers expedition cruising and land based adventure travel experiences. These voyages are delivered through a fleet of 10 owned expedition ships and 5 seasonal charter vessels under the Lindblad brand.
These expeditions are truly like none other, especially considering that it's a joint venture between National Geographic and Lindblad. The locations range from Antarctica to the Galapagos Islands to the Mediterranean and even Iceland. As one would expect, though, the company is definitely struggling with being profitable. Revenue is at least somewhat consistent, but the company constantly flips between generating net income and recording a net loss.
Certainly, time to add one of these to our bucket list. I would definitely like to try one of the expeditions, just like I got a chance to go check out Seaport District in New York last week because we were interested in the company. So we should do one of these expeditions because we find the company interesting.
Right, they are incredibly pricey though.
I saw that. That's why I said bucket list and not something we can do right now. The stock is up 24% in the last year, and we are pretty much used to seeing insiders buy shares from time to time at this company. And these insiders are either various directors or the company's co founder, Sven Olof Lindblad. What really made us do a double take was when we looked into the background of one of the directors that bought shares this week, Alex Schulz.
Mr. Schultz has been a director of Lindblad since February 2022, but he's also the chief marketing officer and VP of analytics at Meta, of all places, a company he's been with since 2007. Even more interestingly enough, he has a master's in natural science from Magdalene College in Cambridge, where he specialized in experimental and theoretical physics. Mr. Schultz clearly has an absolutely fascinating background, and I'm curious to see how he got involved in Lindblad in the first place and what he sees in the company to continue purchasing shares.
Switching gears to activists, H Partners was out with a new presentation about Harley Davidson that had a lot of interesting tidbits about both H Partners and Harley Davidson. I was shocked to read that H Partners runs extremely concentrated with just 3 positions in their portfolio. This reminds me of Nick Sleep and Case Zakaria, where they both ran extremely concentrated for years. I guess it works out great when these positions are companies like Amazon and Costco, but sometimes not as much when one of the 3 companies you have in your portfolio is Harley Davidson.
H Partners first engaged with Harley Davidson in 2014, and the presentation does an excellent job of helping you understand the company from an investor that has been involved for over a decade and has had board representation.
Yeah, like I mentioned in our last episode about their electric bike spinoff, Livewire, the bikes neither looked appealing to me nor were they priced attractively. They were actually quite expensive. The presentation describes just how badly they missed the mark with their electric bikes. Their projections were for $400 million in sales in 2024, or to be more precise, $385 million. And they ended up with just $26 million in sales. So they missed the mark by, I think, like 96% or 97%. A turnaround at Harley is likely to be a long, arduous road, but the brand is so valuable that it feels like, in the right hands, they can engineer a turnaround. PE firms don't always get it right, but this seems to be an excellent opportunity for a PE firm to step in and acquire the company to turn it around out of the public eye and the pressures of reporting earnings quarterly.
Moving on to another activist situation, the billionaire activist Carl Icahn, who truly needs no introduction, was revealed to have built a 34% stake in Bausch Health. The company primarily manufactures pharmaceutical, medical device, and OTC products for the therapeutic areas of eye health, gastroenterology, and dermatology, and its stock rose by over 15% in the last week following the announcement of Carl Icahn's involvement. Carl Icahn directly holds 9.4% of the company's shares outstanding, but has exposure to an additional 24.6% or 90.72 million shares through cash-settled equity swap agreements. These equity swap agreements allow Icahn to benefit from movements in the company's stock price without ever actually owning the shares directly.
Reminds me of the swap agreements that Bill Ackman used for his stake in Hertz. And it also reminds me of the little tiff both of them, Carl Icahn and Bill Ackman, had on CNBC related to Herbalife.
Yeah, whenever we see insider purchases at Herbalife, which surprisingly enough we frequently do, I'm always remembered of the battle between the two.
Indeed. Coming back to Bosch, according to Bosch, Icahn is refusing to provide copies of the swap agreements to the company's lawyers. But Icahn has said that they were accumulated through over 100 trades that took place between May 2021 and September 2023. Bausch Health adopted, as you would expect, a poison pill provision earlier this month to ward off hostile acquirers, even though the company noted that there were no specific proposals or takeover bids announced. Bausch Health is currently struggling with a $27 billion debt balance as of the end of last year, and the company has hired financial advisors to help with its debt.
We'll wrap up today's episode with a look at some interesting C-suite transitions. Match Group's CTO and Chief Product Officer, Will Wu, is the next executive to leave the company after the new CEO, Spencer Rascoff, joined a little over 2 months ago. I actually had the opportunity to hear from Spencer Rascoff directly at a talk he gave at UCLA last week. And I remember coming back and telling you that he was an extremely good salesperson, because even though the talk was centered around entrepreneurship, he still did a great job of explaining how exactly he could turn Match around, starting with redefining Tinder to be an app more catered towards the new generation, Gen Z. I mean, I was almost ready to go out and buy Match stocks right then and there. I certainly think he has his work cut out for him ahead of time, but Match owns Tinder and Hinge, two of the largest dating apps, and I do think the company has some incredible potential in that sense.
Yeah, I think the problem extends beyond Match. Bumble is not doing very well either. And in some sense, it would make sense for Match to acquire Bumble, but I don't know if a deal like that would pass regulatory approval.
Highly doubt it will.
Yeah. Another transition that we saw last week was with Avanos Medical, where they hired a full time CEO, and the interim CEO, who was also the company's former CFO, decided to leave. And when leaving, he claimed that the company did not give him an equivalent role. And actually, when you think about it, he did take a risk by, from stepping up from the CFO role to an interim CEO role. But as you know, often when a new CEO joins a company, they end up building their own management team, and the CFO is a critical hire for them. So it makes sense that the former CFO, unfortunately, even though he stepped in as interim CEO, is having to leave now.
And with that, we'll wrap up episode 16 of the Special Situations Report. What we've covered today is just a brief overview of the special situations landscape. So if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com. for daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities, such as the merger arbitrage tool. Check out insidearbitrage.com.
If you enjoy this podcast, please take a moment to like and subscribe on whatever platform you might be listening on, and especially share it with your friends who are interested in special situations. We have an excellent upcoming guest for our next podcast, and I think you'll find that conversation to be absolutely fascinating. Thank you for listening.